Welcome to Mastering SIPs, the systematic path to financial freedom. This video explores how systematic investment plans can help you achieve your long-term goals. We all dream of financial freedom, a life where money works for us. This could mean a dream home, early retirement, or the ability to travel the world. However, the market is inherently volatile. The ups and downs can be scary, and the fear of timing your entry often leads investors to miss out on significant growth opportunities. The solution to this volatility challenge is the SIP, or Systematic Investment Plan. What exactly is a SIP? It is not a product. It is a disciplined process. It is a method of regularly investing a fixed sum into a mutual fund scheme. Think of a SIP as your autopilot savings. You set it up once, and it consistently builds wealth in the background, like a recurring deposit for the stock market. With SIPs, discipline is more important than market intelligence. Consistency in saving enforces a habit that minimizes emotional decision-making when the markets fluctuate. The secret weapon behind the success of SIPs is rupee cost averaging. In scenario A, when markets fall and the net asset value NAV is low, your fixed installment buys more units. For instance, 5,000 rupees might buy 500 units at 10 rupees each. In scenario B, when markets rise and the NAV is high, your fixed installment buys fewer units. For example, 5,000 rupees would buy 250 units at 20 rupees each. The net result of this strategy is that you automatically buy low and acquire units at an average cost lower than the average market price over time. Rupee cost averaging ensures smooth sailing. It effectively smooths out the stock market's bumpy ride, turning volatility into a key advantage. SIPs also benefit greatly from what is often called the eighth wonder of the world, compounding. Compounding creates a snowball effect. Your returns begin to earn returns. A small start can eventually turn into a financial avalanche. While growth may seem slow initially, as the corpus grows, the interest component eventually starts exceeding your actual investment. This is the difference between linear and exponential growth. The gap between your total investment and the total value widens drastically over the long term. Time is the most critical element in compounding. Start early and stay invested for the long term. A 5-year delay can cost you half of your potential final corpus. Starting a SIP is surprisingly easy. It is simpler than ordering a pizza. Step 1. Select the platform. Choose a reputable asset management company or an aggregator app with a user-friendly interface and good support. Step 2. Complete your KYC. Know your customer is a mandatory, one-time process, now easily done digitally by uploading your necessary identification documents. Step 3. Choose your scheme. This decision should align with your specific financial goals and timeline, whether you opt for equity, debt, or hybrid funds. Step 4. Set the mandate. Automate the process by linking your bank account, so the SIP amount is automatically deducted on a fixed date each month. Once set, you can practically forget it. Your wealth creation is now on autopilot. Remember, there is no single best fund for everyone. There is only the best fund that aligns with your personal investment needs. For the long term, typically 5 years or more, consider equity funds. While they have high short-term volatility, they historically offer the best inflation-beating returns. For short-term goals like 1 to 3 years, debt funds are ideal. They invest in bonds, offering lower risk and stable returns, perfect for emergency funds. Hybrid funds offer a middle path, mixing equity and debt. This combination provides growth potential while maintaining a cushion of safety. The first selection metric is the track record. Look for funds that consistently beat their benchmark over 5 to 10 years, not just last year's top performer. Selection metric 2, the expense ratio. This is the fee paid to the fund manager. Lower is better. Direct plans often have lower expense ratios than regular plans. Selection metric 3 is the risk profile, often measured by the Sharpe ratio. This tells you how much return the fund generated for every unit of risk taken. A common myth is waiting for the perfect market dip. Waiting often leads to paralysis, causing you to miss the best growth days while your money sits idle. Remember this critical rule: time in the market is always greater than timing the market. SIPs offer flexibility, especially compared to large lump sum investments, by minimizing the risk of entering the market at a peak. You can start small, with amounts as low as 500 rupees monthly. You can also pause any time without penalty and step up your SIP amount as your income grows. As Jim Rohn said, discipline is the bridge between goals and accomplishment. SIPs provide that necessary financial discipline. Your wealth journey requires a few simple steps. Start early, automate your investments, ignore the market noise, and stay invested for the long haul. We are available to discuss your financial future and any questions you may have about starting your SIP journey. This video includes images sourced from various platforms as listed here. Here are additional image sources used throughout the video.